Welcome back to Entrepreneurial Edge. In the world of money, complexity is often a smokescreen for a bad deal. The more complicated something looks, the more likely it is that someone is trying to hide the truth or distract you from what really matters. People dazzle you with jargon, endless charts, and technical terms to make you feel like you need their expertise. They want you to believe that only they can navigate the maze, so you hand over your money in trust. But Warren Buffett, one of the world's most successful investors, built his fortune on radical simplicity. He's proof that you don't need to be a genius or have a PhD in finance to win at investing. Buffett uses a mental checklist, a 1-minute analysis, to cut through the noise and get straight to the heart of a business. This simple process helps him avoid mistakes and focus only on what truly matters. Buffett's genius isn't about predicting trends or chasing the next big thing. It's about discipline, patience, and focusing on business fundamentals that stand the test of time. He asks himself a few key questions. Can this business survive tough times, grow steadily, and make real money over the long run? Is it built on a solid foundation? This approach isn't just for billionaires or Wall Street pros. It's for anyone who wants to protect and grow their money, whether you're investing a little or a lot. Forget the constant noise from financial news and market predictions. What you really need is a repeatable, reliable process that you can trust every single time. Buffett's method is about being a business analyst, not a market speculator. He looks at companies as real businesses, not just stock symbols or numbers on a screen. We're going to break down this 1-minute analysis into its core components, a series of gates that every business must pass before you invest. If a business can't pass each gate, you simply walk away. No emotion, no second guessing, no fear of missing out, just clear, confident decisions. This is how you stop gambling with your money and start investing with purpose and confidence. Pay close attention. What you're about to learn is the foundation of real, sustainable wealth. It's the mindset and process that separates successful investors from the rest. Remember, it's not a get-rich-quick scheme, it's a get-rich-for-sure strategy if you have the discipline to stick with it and trust the process. Rule 1. Understand the business. This is your circle of competence, the area where your knowledge is strongest and you truly grasp how things work. If you can't explain how a company makes money in simple, everyday language, don't invest. You should be able to break it down so a friend or even a child could understand. Stick to what you know best. The more familiar you are with an industry or business model, the better your decisions will be. There's no shame in passing on what you don't understand. In fact, it's a sign of wisdom and discipline. Next, look for a moat, a durable competitive advantage that protects the business from rivals and imitators. Is it a powerful brand, a valuable patent, or a cost edge that competitors can't match? Maybe it's a network effect, or exclusive access to resources. Without a moat, profits get eaten by competition. Rivals will copy success and drive down returns. Then, check for consistent earnings. Reliable profits are a sign of a healthy, well-run business. One good year isn't enough. Anyone can get lucky once, but you want more than luck. You want a track record, 5 to 10 years, of steady, growing profits. This shows the business can perform through good times and bad. Consistency shows resilience and a business model that works, even when the market changes or challenges arise. The numbers tell the story. Erratic earnings mean chaos. Steady earnings mean reliability and predictability. Historical consistency is your best clue about the future. Past performance can reveal how management handles adversity. It proves the moat is real and management is effective, steering the company toward lasting success. Don't fall for hype. Demand the numbers. Let the facts, not the noise, guide your investment decisions. Next, it's crucial to check for strong returns on capital. This is a key indicator of a company's ability to generate wealth over time. For every dollar invested, ask yourself, how much profit does the company actually generate? This simple question reveals a lot about efficiency and management quality. High, consistent returns mean the business is a true cash machine, able to reinvest and grow without constantly seeking outside funding. On the other hand, avoid companies that constantly need more money just to survive. These businesses often struggle to create real value. Now let's talk about debt. Debt can be a silent killer, especially when times get tough or the economy turns. Warren Buffett avoids companies drowning in debt, so should you. Look for a low debt-to-equity ratio, which signals financial discipline. A clean balance sheet means the business is built on a solid foundation, able to weather storms and seize new opportunities. High returns and low debt together signal true financial health and independence, making a company more resilient and adaptable. This is how companies not only survive crises but also continue to reward shareholders with dividends and long-term growth. Each step acts as a filter. Only the best, most robust businesses make it through to the next stage of your analysis. But don't stop at the numbers. There are still two more important gates to check before you can be confident in your choice. Getting the numbers right is essential, but it's only the beginning. There's more to a great business than just financials. Even the best business can be ruined by bad management. You're betting on the people running the company, not just the business itself. Look for honest, transparent leaders who think like owners. Read annual letters. Do they admit mistakes and allocate capital wisely? Great management is a hidden asset. Finally, the most important step: buy at the right price. Buffett says, "Price is what you pay, value is what you get." Calculate the company's intrinsic value and wait for a discount, the margin of safety. This protects you from mistakes and market swings. When the price is right, buy. If not, wait. Patience is your weapon. Discipline wins in the long run. Here's Buffett's 7-step checklist. Understand the business. Confirm a durable moat. Check for consistent earnings. Look for high returns on capital. Verify low debt. Assess management's integrity and competence. Buy only at a significant discount to intrinsic value. This process turns you into a business analyst, not a gambler. It filters out weak businesses and protects your money. Use this framework every time you invest. Be tough, disciplined, and patient. Your future self will thank you. That's how you win, the Buffett way. Warren Buffett's 1-minute business analysis isn't just for billionaires, it's for anyone determined to invest smarter. Keep it simple. Demand quality. Never settle for less than excellence. Now take these timeless principles and put them to work in your own decisions, whether you're investing, starting a business, or just managing your money. The path to financial success is built on discipline, patience, and a sharp eye for value. Start today and let Buffett's wisdom guide your journey.